Hi, everyone. Welcome to the Regulatory Developments and Technical Accounting Update provided by RGP. I'm Janis Parthun, and in today's session, I'll be highlighting regulatory and standard setting updates, developments, as well as accounting updates in the last about 6 to 8 months. And a little bit about myself. I'm a finance and risk leader. I'm also a VP within our project consulting services team at RGP. I currently lead thought leadership as well as service innovation development on emerging finance and risk issues. I'm also the ESG reporting services leader here as well. A little bit about RGP. RGP is a global consulting company that serves over 2,200 clients, which includes over 3/4 of the Fortune 100. RGP enables rapid business outcomes by bringing together the right people who together create transformative change. And it's a daring to work differently to deliver the future of work today. Now, I just want to make sure I provide a little bit of disclaimer before providing the technical update. The views expressed in this presentation are those of mine and do not necessarily reflect the views of others. And these slides are for educational purposes only and not intended to be reflected upon as accounting, tax, or other professional advice. Now, what we have on the agenda today, I'm going to provide some regulatory and standard setting developments, highlight a few key topics, and then wrap up with a PCAOB update as well. Now, before we start, I wanted to start with the first polling question. Just so I have an understanding of the audience here today, which organizational function do you currently represent? So if you can respond to that, we'll give it a little bit of time just so I have a little bit background who is attending today. That would be great. We have finance, internal audit, legal, audit committee or board member, or other. And then we'll see who is joining us today. Great, so we have a large, significant portion from finance, over 50%, as well as internal audit and other. So great, welcome. All right. So to start off with, and before I dive into the developments and updates, I usually like to start by providing background and clarity around the different SEC divisions and offices and their objectives, as well as reference these groups from time to time. And now ultimately the SEC's role is to protect the investors and to facilitate market formation. But this also includes having oversight responsibilities over in terms of from a standard setting bodies perspective, which includes FASB, and because the SEC has power to enforce with the public companies. But with this responsibility, it does impact the private companies and nonprofit organizations. So I do tag the OCA has been providing consultation on accounting, financial reporting, as well as auditing concerns and questions, especially those with unusual and complex or innovative transactions, which doesn't have necessarily clear authoritative guidance that exists, as well as issues regarding auditor independence. The DCF oversees corporate disclosure compliance with security laws and SEC regulations, and is required to review each company filing every 3 years as required by Sarbanes-Oxley Act. The SEC staff provides comments in response to the company's filings and are often referred to the correspondence as comment letters. And so that's coming from the DCF. Now, if a company's conducted something that's significantly misleading, there is also the Division of Enforcement, which conducts the investigation into possible violations of the federal security laws and prosecutes the commission's civil suits in the federal courts. And so these are the main three divisions that you may hear throughout the presentation, just depending on the topic or which section that I'm referring to. Now, with the rulemaking activities, I want to just highlight a few here that's noted. And I thought it'd be good to highlight these two rules that are finalized recently this year. And then I'll elaborate a little bit more on the cybersecurity rule, actually later on in the second section. So in terms of the share repurchase disclosure modernization, which is the final rule that was issued in May, effective end of July, the amendments that were finalized require disclosures related to the issuer's share repurchases that will provide investors with enhanced information to assess the purpose and the effects of the repurchases. And so this is not necessarily a new requirement because corporate issuers are already required to disclose a certain level of detail, but this is an enhanced requirement with additional disclosures to include. I also want to point out the SEC proposed a significant number of rules in last year, 2022, but the organization ran into some system issues, and so they didn't necessarily receive all the submissions, and so the comment period was reopened through November of last year. And there were 12 proposed rules, which this occurred. And so I just want to bring attention to the two here that's still pending, and I'll discuss this a little bit later under the key topics as well, that they have a significant impact. So I would say be on the lookout in terms of the future developments on these two here, which one is the climate-related disclosures rule and then SPACs, and I'll cover these in a little bit later. Okay, let me just change my slide. Now, transitioning to the standard setting perspective, I want to highlight some of the FASB's activities to date. So FASB has issued an invitation to comment back in 2021, which helped reshape the board's priorities and projects. And now there are currently multiple projects on FASB's technical agenda. And I'll provide a list in the next slide, actually, that will have a little bit more detail in terms of what's been coming out this year. But I'll only highlight a few here and also discuss some under the key topics. So in terms of the projects to highlight, I want to highlight the first one is the accounting for and disclosure of crypto assets. And note, this used to be referred to as digital assets, but this has been updated recently with FASB. And the objective is to be able to improve the accounting for certain crypto assets by requiring the entity to measure these crypto assets at fair value each of the reporting period, with changes in the fair value recognized in the net income. The proposed amendments would also include requiring disclosure about significant crypto asset holdings, restrictions, and changes in these holdings. And FASB's received sufficient comments that they are targeting to issue the final ASU in the fourth quarter of this year. The other one I just want to call out is segment reporting. The objective of this project is to improve in terms of the segment disclosures to provide users with more decision useful information about reportable segments of the public entity. The improvements include having disclosures of significant segment expenses, expanding interim period requirements, allowing disclosure of more than one measure of segment profit and loss, and this will also apply to single segment entities as well. So stay tuned on this one. This is actually going to be coming out pretty soon. FASB is targeting to issue the final ASU in the third quarter, this quarter of this year. The other thing I just wanted to briefly highlight is the conceptual framework revision on recognition and derecognition. And so the intent here is to add a new chapter to the conceptual framework that's related to the recognition and derecognition of an item in the financial statements, and to provide additional non-authoritative guidance. And it was recently finalized and issued end of August. Now, in terms of IASB, Andrew Sparkhouse, IASB chair, had shared his thoughts at the IFRS Foundation conference recently in June on the IASB priorities and projects. And the standards on intangible assets have been more than 20 years old, and it was written with a different objective in mind. So IASB is continuing to look and research into this particular area. And then the standard on a statement of cash flows also needs an overhaul since the guidance lacked details about non-cash transactions to consider, and it's also been impractical for certain industries. Amendments finalized for this year also include supplier finance arrangements. That is an amendment to IAS 7. And it's requiring to provide information about terms and conditions of such arrangements related to liabilities, payment due dates, and liquidity risk. And this was issued in May of this year, and it's effective starting in January of next year. Now, the International Tax Reform Pillar 2 Model Rules is an amendment to IAS 12. This amendment is giving companies temporary relief from accounting for deferred taxes arising from the International Tax Reform. And this was issued in May of this year, and it's effective this year. And then in the last segment of the agenda, I'll be providing a summary update around PCAOB. Okay. And as I mentioned before, I wanted to just share a quick highlight around the FASB updates this year, starting in terms of the beginning of the year. And so FASB's completed 5 projects and published the accounting standard updates, or ASUs, here as of this month. And I'm providing a list just for awareness purposes in case this applies to you and you may want to take a look further detail. But I'm just going to quickly highlight. Now, in terms of ASU 2023-01 around leases, this is to address private company stakeholders' concerns about applying topic 842 to related party arrangements between entities under common control. And there are 2 issues being considered here. And the first is applicable to private and nonprofits, and the second is applicable to all. And so, as you noted here, as you can see, I've also noted in terms of applicability from a date perspective as well. In terms of from ASU 2023-02 on investments, the accounting for investments and tax credit structures using proportional amortization method. This is to be able to consistently account for equity investments made primarily for purpose of receiving income tax credits or other income tax benefits. And in terms of this applicability for public companies, this is applicable December 15 of this year. And then for all other, it's December 15 of next year. And this also includes interim periods within the years noted. Now, I want to also just highlight briefly in terms of ASU 2023-03, as well as ASU 2023-04. Now, both of these primarily are in terms of providing amendments to the FASB's accounting standards codification. And the purpose really is just to conform to SEC communications. And so they're not necessarily new guidance, and therefore there's no transition or effective dates around these. It's really just to align the language to what the SEC has already communicated, and it's not necessarily new guidance. Now, in terms of ASU 2023-05, this is around joint venture formations. And so the purpose here is to be able to reduce the diversity in practice. FASB is requiring that a joint venture apply a new basis of accounting upon formation and recognize the measuring of the assets and liabilities at fair value, and with a few exceptions to the fair value measurement. And this is applicable to entities with formation dates on or after January 1 of 2025. And then, as I mentioned earlier, segment reporting will be coming out fairly shortly within this quarter. And so you'll want to stay tuned to that as well. That's a pretty big one. So with that, that is more so a quick highlight of the regulatory and standard setting updates. Now next, what I'd like to do is dive further into some of the key topics and highlight more specifically around those topics. But before we do that, have the next polling question. So what I'm interested and curious to hear from you is, which topic is of significant interest for you this year? Is it digital assets? Is it ESG? Is it cybersecurity? Is it around internal controls? Or is it some other that perhaps you might be able to hear later in the session? So we'll just give it a minute or so to answer. Okay, so we have our responses here. And this is great. So we have some interest here around cybersecurity and internal controls. Seems like that's kind of the top with approximately 30%, and then ESG around 20%, and then other. Okay, well, this is great, and we will cover all of these topics in the next and within this hour. Okay. So cybersecurity, this is what I'm starting off with, and that was a great response. That was the highest percentage. So what I wanted to share is the final rule around cybersecurity, and more so from a timeline perspective and how it applies. So the first topic highlighting here is cybersecurity. It's a significant proposal back in March of last year. The SEC have proposed rules and amendments to enhance and standardize the disclosures around cybersecurity risk management, strategy, governance, and incident reporting by public companies. It's now official, finalized and issued in July, and it's effective starting September of this year. So to expand a little bit more, the rule requires essentially a new Form 8K to report material cybersecurity incidences within 4 business days of confirming the materiality. So it's not based on when you discover the incident. It's more once you confirm that this is material, you have 4 days to report that. And also the other aspect of the requirement is the disclosures under Regulation SK, which includes disclosing the policies and procedures, management's role, and the board of director expertise on how entities identify and manage the cybersecurity risk. And it also includes reporting on prior material incidents. Now, the compliance dates are just around the corner, and so with Regulation SK item 106, this is having to disclose which company, or describe the company's processes for managing the cybersecurity threats, which I just briefly mentioned above. And so it's for fiscal years on or after 12/15/2023. So it's coming up very shortly. And then the Form 8K, which is the disclosure of material cybersecurity incidents, that starts in terms of December 18, 2023, which oddly is just 3 days after in terms of what was said by the SEC, but it's around the same time, and it is also around the corner in terms of how when it applies. And then after that, you have a year to be able to make sure that the information that you're submitting is going to be in line XBRL. It will be tagged in XBRL, so essentially required 1 year after the initial compliance, so in 2024. And then for small reporting companies, you have additional time to comply, but it also will be applicable to that as well. Okay. Now, the other topic I just want to highlight and elaborate on is around ESG reporting, which stands for environmental, social, and governance. And now the topic is not new, and there are significant funds and investments around this. If you can see here, over 96% of the SB 500 voluntarily publish sustainability reports in some form or fashion, and over 150 billion in net new money generated in 2022 internationally focused on sustainable funds. And then 370 billion in investment targeted on emission reduction and promoting green technology. So because of all this, the wave of activities, the funding, things of that sort, regulatory and standard setting bodies are really paying attention. And I'd like to dive into this a little bit further in reference to that. And so to dive further into this topic, there are developments from multiple fronts. This is related first, having to relate to the financial reporting and annual filings. So the SEC has already issued amendments that require businesses to include human capital disclosure that became effective late 2020. But in terms of the proposed rules, the SEC has two, one applicable to the registrants, subject to the investors, and the other applicable directly to the investor community. And so many have been talking about this, and I'll elaborate a little bit more for the investor proposed rule. But in terms of the one for the investment community, I'll just highlight here briefly that the ESG disclosures for the investment advisors and the investment companies. The goal of the proposed rule is to be able to determine whether a fund or an advisor's ESG marketing statements represent concrete and specific measures taken to address the ESG goals and the portfolio allocation. The proposal requires the investment communities and advisors to disclose their ESG strategy, present in a tabular format for easier comparison across different funds, and then also for environmentally focused funds to disclose the emissions associated with the portfolio investments. Now, in terms of the other rule proposals, I also just want to call out in terms of from a future perspective what might be in the horizon. And so this is the human capital management disclosure is to propose amendments to enhance the registrant's disclosures regarding human capital management. And it's planned on SEC's agenda for October this year. So I would say be on the lookout for that. That's what we're anticipating based on their agenda list. And then corporate board diversity. The SEC is also planning to propose amendments to enhance the registrant's disclosures about the diversity of the board members and nominees, and then planned on the SEC's agenda for April of next year. So that is planned in terms of having to issue out a proposal. Now, in terms of from a FASB perspective, from an accounting setting perspective, the Accounting for Environmental Credit Programs, this is on the FASB's agenda to assess requirements for participants in compliance and voluntary programs that lead to the creation of environmental credits. And the credits may include those credits under the compliance programs, such as the cap and trade and baseline allowance programs, or essentially emissions trading involving federal and regional programs, and renewable energy credits and certificates, renewable identification numbers, carbon offset credits. And this project also evaluates financial reporting requirements for non-governmental creators of environmental credits. Now, really the focus of this is on credits that are enforceable and traded, and not for pertaining to tax credits or investment related. And the topic initiated because of the diversity in practice without much direct guidance, such as whether the transaction should be accounted for as inventory or finite-lived intangible assets when purchased. But this is still in board deliberations. It hasn't quite changed in the last 6 to 8 months on this one. Now, the other is the research project definition of a derivative, which previously it was referred to as accounting for financial instruments with ESG-linked features. And since many have challenges in terms of applying guidance on derivatives, for example, bonds where the interest payments vary based on sustainability-linked metrics, the objective is to be able to consider refining and clarifying the scope to these types of derivatives. And I would say stay tuned on this one since that's it's also pretty applicable, and we'll see if FASB ends up transitioning this in terms of having to have this on the standard setting agenda. Okay. Now, just to dive a little bit deeper into the climate-related disclosure, as many of you have already been aware, in March of last year, the SEC proposed rules to enhance and standardize the climate-related disclosures as the investor community is demanding for more comparable, consistent, and reliable information across companies. The proposed disclosures, specifically climate-related risks, will require public companies to disclose details, specific contents when submitting the filing in the registration statements or annual reports, depending on the timing. And this includes having to include oversight and governance, material impact to the business and future outlooks, the process to identify, assess, and manage the risk, greenhouse gas emissions, the scope 1 and scope 2, and scope 3 of material, impact of possible climate-related events, and this includes disclosing financial impacts when summed cumulatively greater than 1% of a significant line item on the financials. And details on climate-related targets or goals publicly set or stated, and then any other information such as scenario analysis or transition plans. Now, this also means that the information disclosed would need to be tagged in inline XBRL, and it's subject to SEC's rule on disclosure controls and procedures. Now, for large organizations, accelerated filers, an additional requirement is to obtain the reasonable assurance on the scope 1 and the scope 2 emissions. And SEC proposal includes a phased approach for implementation. And I would say that the elements that really most sensitive for registrants or causing stirs for companies are the limited and reasonable assurance requirements, estimating the financial impacts to possible climate-related events, and reporting on scope 3 emissions. These are major concerns for companies. And small reporting companies and non-accelerated filers are not listed in the assurance requirements, but the entities are still subject to disclosure controls and procedures. Now, I included the proposal here as well as the blog for reference, and many of us will be monitoring this very closely. What I wanted to share is that from a marketplace perspective, we are anticipating that this will finalize by October of this year, since it is on the SEC's forecasted agenda. But what will the compliance date look like? So let's say you are a large accelerated filer with a 12/31 year-end date, and the SEC existing proposal timeline here for large accelerated filer suggests fiscal year 2023, filed in 24. But this was also under the assumption that the rule is to be finalized in December of last year, as specified in the proposed rule. And so I would say that the SEC is likely to adjust and present the updated timelines in the final rule to align to the effective date, but it only would likely shift 1 year out. And so you can see here that in terms of from a, let's say, large accelerated filer perspective, likely this may be applicable starting the next fiscal year in 2024 for 25 filing. So I just wanted to provide that clarification from a timing perspective. Okay. And now on the international front, Now, the shift towards compliance is already happening internationally and advancing further than the US. So the IFRS Foundation has created the International Sustainability Standards Board, or ISSB, back in 2021, and focused on sustainability-related disclosures to be able to help investors make informed decisions about ESG matters. And there's been significant progress since then. The ISSB has issued 2 standards since in June of this year, and this includes IFRS S1, general sustainability-related disclosures, and setting out overall requirements for an entity to disclose, to communicate to investors about sustainability-related risks and opportunities that they face in the short, medium, and long term. For IFRS S2, climate-related disclosures, this is building upon recommendations of the TCFD, setting out specific climate-related disclosures, and it's designed to be used with IFRS S1. And while the ISSB standards are officially issued, these are not mandated unless the country or the jurisdictional authority decides that companies should comply. However, ISSB is working with jurisdictions and companies to support the adoption. So I would strongly suggest to stay close on this because they are aggressively doing that to have other jurisdictions to start aligning to ISSB. Now, the other comment that I'll add, and that there's been also a consolidation of voluntary standards and frameworks occurring recently, with first FASB being consolidated under ISSB back in 2022. And then now TCFD is going to be rolled under ISSB in 2024. So there's likely more to come in those activities. Now in the EU, the European Commission has adopted a new rule, Corporate Sustainability Reporting Directive, for companies to publish detailed information on sustainability matters to increase a company's accountability and to prevent divergent sustainability standards, effectively starting in fiscal year 2024. And the European Financial Reporting Advisory Group, or EFRAG, is responsible for developing the European standards and have developed 12 associated standards, here pictured here as I'm showing you on this slide. And since then, the European Commission has officially adopted the set of standards, ESRS, issued in July. And I would say there are little nuances to consider in terms of the applicability. And this would be a phased-in approach for companies to be able to require the consideration of the entity structure, as well as the origin of the revenue being generated. But just really at a high level, this would be effective starting in 2024 for EU-listed companies that were previously under a prior non-financial reporting directive, and then extends out to 2028 for non-EU companies that meet certain criteria to report at the corporate consolidated level. And so definitely want to be on the lookout for that if you have any international operations. If you're a US company but have international operations, this may likely apply to you. All right. So the next hot topic I just want to talk about a little bit is in terms of digital assets. And from a digital asset perspective, before we go into detail on this, I thought it'd be good to just provide a little bit intro, and I like how NASDAQ explains these assets. So I'll just highlight this briefly and talk about what's coming up. So the first one is cryptocurrency, the digital currency that's secured by cryptography via the blockchain technology, securely recording information that cannot be altered. It can be used as a form of payment or investment. There's also Bitcoin and Ethereum as examples, but what people tend to hear about really around that, the Bitcoin and Ethereum. Asset-backed tokens. Physical assets can be tokenized and traded among users on the blockchain through the usage of asset-backed tokens. The tokenization of these assets can help liquidity problems with assets, and examples may be gold, oil, real estate, or specific investments as examples. And then you have non-fungible tokens. The asset token is unique and allows for authentication to prove that the token is real and that it's specific to the owner. And there's been a number of artwork and media recordings sold as NFTs. And interesting enough, there's also the central bank digital currency, and it's a digital form of the country's fiat currency or government issued. It's issued and regulated by the country's monetary authority or central bank. And some foreign countries have this, for example, the Bahamas, and China is piloting as well. So that is just kind of a brief intro. And starting from the SEC's perspective, the SEC has shared that certain fraud and investment scams related to crypto assets have increased. And the big one that's recently occurred around executives from the crypto asset trading platform company FTX, charged with fraud and with FTX in bankruptcy due to the leverage and solvency issues. The SEC has been communicating on the crypto asset topic, but more specifically to entities who are custodians of the crypto assets or exchanges that facilitate the crypto asset trading, and then case by case for other situations. And at past conferences, the SEC reconfirmed registrants should be accounting for cryptocurrency under intangible assets and have elaborated more across different scenarios. But companies don't necessarily like this approach since you need to assess impairment at least annually, in which then you can't recognize the value until you sell it. Now, in April of last year, the SEC staff issued Staff Accounting Bulletin, SAB 121, to provide firms that offer custodial services of crypto assets direction in terms of how to record these custodial services on the financial statements. And so specifically, entities who safeguard crypto assets held for their platform users. The guidance recommends firms to record a safeguarding liability and a corresponding asset separate from the underlying crypto asset at the fair value. And I just want to add that the SEC emphasized the importance of having to have terms and conditions clearly disclosed to enable users of the financial statements to understand the rights of the crypto asset holder and the obligations. And then also just making sure to bring in specialists, such as with technology or law background, to be able to make these arrangements and bring the audit complexity and to consider the various risks. Okay. Now, because of the significant volume of transactions involving SPACs or special purpose acquisition companies, back in 2021, the SEC has also issued a proposal in March last year to enhance the disclosures for business combination transactions between SPACs and private operating companies, or the de-SPAC transactions, and to address the treatments involving reporting shell companies, and provide additional guidance on the use of the projections. And now I understand there's significant slowdown along with the increasing inflation and interest rates starting last year. But I thought this is still a good topic to make sure we highlight and cover briefly. And so I'm just going to briefly highlight certain topic areas here, and then we'll jump into the next topic after that. So the SEC has proposed rule out on SPAC, and this is projected and forecasted to finalize in October as well of this year, based on the SEC's spring agenda rule list. And the OCA consultations in prior years, this was a top issue for them and top issue in terms of accounting for warrants. Now, ASU 81540 provides guidance to evaluate accounting for contract warrants. And FASB has also issued accounting standard updates back in 2020 that pertains to equity as additional guidance. The DCF has also previously emphasized the importance of disclosure on financial incentives of the SPAC sponsor in order to be able to complete the transaction. And this includes potential conflicts of interest and the risk to the shareholders who can continue to hold the shares after the SPAC merges. Now, the instrument to redeem or temporary equity is also an area of concern, redeemable either early or after the merger. Shares to redeem early should be classified as temporary and also refer to ASC 480 for more guidance. And as well, FASB has issued the accounting standard updates back in 2021 pertaining to the equity-based call options as additional guidance. So this is only just for reference in case you have interest to look further in detail. All right. Now we have the next polling question, and I'm curious also just to see in terms of your awareness of this. Are you currently aware of the top trends from the SEC comment letters feedback to public companies this past year for 2022? We just give a minute and see your response. That'd be great. Okay, so over 70% of you are not aware of that. And so this is great timing for me to present the next topic to you. Let me move to the next slide. Great. And so the next area I want to just highlight is really the top comment letter trends. And as I mentioned before early on in the beginning, the SEC's DCF division, essentially, they are the ones who focus on reviewing a company's annual filing on a periodic basis. And as they review the filings, they may end up issuing comment letters to provide feedback to the public company, to the registrant in terms of corrections to be made. And so what I want to highlight is a few topics where the SEC DCF have focused on and issued the comment letters. And note that this trend analysis resource here is mainly updated annually. And I've also noted the resource here, but a lot of times the analysis is updated annually. And so I will continue to share that on an annual basis on the updates. So the DCF had shared some key things around MD&A, non-GAAP disclosures, and segment reporting from a conference back in December. So for our management discussion and analysis, MD&A, some of the common themes around here are the results of operations and critical accounting estimates. And I would say the trigger has been the amendments to the regulation SK, which is heavily MD&A focused. And so this had become effective in 2021 to modernize and enhance the disclosures. And so really a key reason here for comments is if entities are not clear on the specifics to implement from the amendment. And so the SEC then in response would end up issuing the comment letters for either clarification or for correction. The other one that's also in the top trends is non-GAAP disclosures. And the themes observed include the prominence of non-GAAP measures. The SEC referred to the compliance and disclosure interpretations around non-GAAP financial measure examples and guidance around this. And so when explaining this, when a registrant presents non-GAAP measures, it must be presented with the most strict comparable GAAP measure with equal or greater prominence. And the key point is that GAAP is the foundation and should be the focus. And so some of the more specific examples, maybe mislabeling of the measures, for example, a mislabeling of a contribution margin and using a non-GAAP measure in place of that. Performance metrics, if metrics are included, disclosures should also be included, such as having a clear definition of the metric and how it's calculated. Statements indicating the reason why the metric is providing useful information to the investors. Statements indicating how management uses the metric in managing or monitoring the performance of the business. And DCF also communicates the importance of being consistent on how the metrics are calculated and then maintaining proper controls and procedures. Now, in terms of number 3, for segment reporting, the DCF has communicated that the common themes have raised concerns. And one is identification of operating segments, as the operating segment should be tied to the entity's decision makers' use of the financial information to make decisions about operating matters. And the DCF also indicated that staff are likely to comment when an entity only has one reportable segment, when there's been changes in the business structure that's been shared publicly or suggest otherwise. And as well as aggregation of operating segments. So the criteria and the quantitative threshold defined in ASU 280 needs to be considered to determine whether aggregate operating segments into reportable segments presented. The change in the reportable segment, if the composition of the segment changed, entities should restate the segment information from prior periods for consistency with the period. And the DCF also noted that it's important to include revised segment footnote if the reportable segment has changed. And lastly is that the SEC staff considers all publicly available information when reviewing the registrant's filings, such as earnings calls, website, industry, or analyst presentations. Now, I have this next one to discuss for our risk management audience here, and it's in the top 7. So for internal controls over financial reporting, some of the key themes that the SEC had identified and had commented back to the public companies really are, one is evaluating the severity of the control deficiencies. So not just individually, but in aggregate when there are multiple or in context such as triggering an immaterial restatement. Are deficiencies appropriately identified in the COSO components other than the control activities? Disclosures of material changes. So not using boilerplate disclosures suggesting no changes have occurred, or if a material weakness noted contained enough description to be understood. And then conclusions on ICFR after a restatement. Since a restatement is typically a sign of a material weakness in ICFR, even if the restatement is immaterial. And then also lastly is missing ICFR evaluation. So those are just some of the key themes here from the top comment letter trends by the SEC. And I believe now we have this is more of a preview in terms of the next session, last segment around PCAOB. And so before we start the last section with the PCAOB updates, I just like to quickly share with this SEC case with you pertaining to internal controls. And this is around Tandy's inventory tracking system that was incapable of supporting its disclosed inventory accounting methodology because it didn't properly maintain the historical cost information for its inventory. And so data from the system populated into Tandy's financial statements with inaccurate financial information. And as a result, you can see there were significant impact to the organization, to the CEO, and as well as having to have restatement of financials. Okay, so now I just want to transition. This is now the last topic I have to cover. And before we do that, we have the last polling question. So besides financial statement matters, what other areas did the PCAOB increase inspection focus? Is it accounting for digital assets? Is it the risk of fraud, internal controls, or all of the above? Interested in seeing what your perspective might be before we dive into the last portion. Great, all of the above. You were right. It is all of the above. So this is a preview, essentially, of what I want to talk about here. Excuse me. So the PCAOB inspects over 200 audit firms and reviews over 800 audits annually across the globe to ensure firms or external auditors are following PCAOB standards. And the PCAOB has been very busy this year. And while officially they just have one standard that's been finalized in 2022, there are several short-term proposals in 2023. And I want to just call out two, the confirmation and substantive analytical procedures, both focused on addressing changes in the technology and to align more closely with the PCAOB risk assessment standard auditor's approach. Although I just want to note that the confirmation is further along and it's targeting to finalize this year. Now, I also want to highlight the inspection focus for 2023. These were highlights from the PCAOB that's published in April. And of course, there are financial statement and reporting matters, but there are also other emerging topics mentioned, which I also called out in the polling questions. So the risk of fraud, looking at what auditors are considering, evaluating the design of controls that are intended to address the risk of fraud, considering how fraud can be considering how the fraud can be concealed in disclosures and any significant unusual transactions. What was the business purpose? And consider the responses from the inquiries of management and the audit committee on possible illegal acts. Inquire about whether management has received tips or complaints regarding the public company's financial reporting. And then digital assets. The PCAOB will continue to select issuer audits where transactions in the digital assets are material to the financial statement. And then additional internal controls focus will include auditors' response to uncertainties in the environment that may cause modifications to the company's operating structure and business process, and auditors' response to company's information technology environment, which may be highly complex. And also information technology has come up a few times here, and I'll also highlight that a little bit in the next slide. The PCAOB has also summarized results and issued a preliminary observation report from the 2022 inspections, which I'll dive a little bit further now here in the next slide. Okay. And this is primarily what I'm going to cover in this last few minutes. And so from the internal audit over financial reporting perspective, for the risk and compliance audience here, it's interesting to see the yearly deficiency trends by topical area and the nature of deficiency that the PCAOB was able to share recently in July from the 2022 inspections. And the 3-year data highlights certain areas in the ICFR audits that are generated with the most comment forms since 2020. Now, the top 3 here, one is the testing controls with review element. This has continued to be a continued trend that when there's insufficient evaluation, whether controls with the review element selected operated at the level of sufficient precision, such as procedures to identify an item for follow-up and to determine where those items were addressed. The other one is identifying and selecting controls to test. where controls identified and tested were not relevant to the assessing of the risk of the material misstatement. And then the third one, just want to call out, is identifying and testing controls over the accuracy and completeness of information that's used in the operation of a control. And this is a critical error when deficient because of control reliance. Now, Figure 11 illustrates the financial statement in terms of the financial statement impacts as in terms of where it impacts ICFR. But I thought it's interesting, I wanted to call out here in terms of pointing out to information technology, as the number has increased to 10% from the 2022 inspections. You can see here initially it started out 6%, 5% prior years, and then it doubled into 10%. So I would say, be aware of that in terms of from a upcoming inspections perspective. And then lastly, from a PCAOB inspections, other areas to focus on, I would just want to call out in terms of now that this already illustrates the financial areas to cover, but in terms of other deficiencies, that's still in the top, which is CAMS, the critical accounting matters, or I'm sorry, critical audit matters, audit committee communications, and fraud. So these continue to be really still issues that the PCAOB continues to identify. And I also want to just call out from a fraud consideration perspective, this actually had increased in 2022 inspections to 8% from 4% in the prior year. So it really is, PCAOB is really having to focus on this quite a bit more, doubling the amount of concerns identified versus in prior years. And so part of this is with the focus on the financial reporting process, with concerns about not performing journal entry testing around populations associated or the characteristics of the journal entries. So that is where the PCAOB concerns have around that. And then in terms of from a CAMS perspective, it's really more about including matters that should be analyzed as potential CAMS or other instances where there's not necessarily a clear description of the CAMS. So just wanted to provide that to clarification there. Now, this wraps up in terms of the regulatory updates and as well as from a technical accounting perspective. I want to thank you for your time and joining me for this hour. I hope this has been very helpful for you. Please feel free to reach out to me if you have any questions, or if you submitted questions in the chat, I'm happy to answer and respond back to you at the earliest convenience. So thank you for your time, and have a great rest of the week.